Ekonomist'ten herkese merhaba. Londra İstanbul hattında piyasalara özel bir parantez açıyoruz. Bu bölümde ekonomist Simon Quijano Evans'la birlikteyiz. Simon, thanks for joining our program.
Thank you.
First of all, let's start with the big picture. The global, the Fed uncertainty and tariff anxiety. Do you think the markets are pricing in all the risks correctly right now?
No, it's a very interesting question because at the beginning of the year we saw the reaction, the initial reaction. I think that generally markets are still not pricing in the potential for bigger risks. And as you know, the 1st of August is now the next date everybody's focusing on. And the thing is that the macro data everywhere are a bit mixed. So in the first part of this year, we saw a lot of US companies building up stocks and selling their stocks. So that pushed up GDP growth, and it did help in some other countries, and a lot of exports, if you like, going from places like China as well. But there's a lot of uncertainty in the second half of this year if we don't know exactly what's going to happen with tariffs.
Everybody's talking about the bond market nowadays. Do you see a risk there? Because some say that there is a systemic risk that can trigger a global crisis again.
Look, all of these things are things that we don't know about and that can suddenly happen. It happened here in the United Kingdom at one stage a few years ago, if you remember. Yes, very big surprise. And honestly, this could happen anywhere else, whether it's Europe or the United States or China, Japan, for example, as you say. We just don't know. I think the thing is that everybody's betting on these things not happening, but suddenly a surprise does happen, like, for example, when foreign entities were probably selling US treasuries when the tariffs noise started a few months ago. And I think that came as a big surprise for the US Treasury Secretary, as it did for the markets as a whole.
The yields are increasing. So what do you think is being priced in there?
Look, in my opinion, if you look at the 10-year and 30-year US Treasury, for example, 30-year US Treasury is pricing in more risk, if you like. The 10-year has been sort of up and down this past 6 months, if you like, sometimes reaching 4%, now at around 4.5%. So I think that is the range that we'll see. I don't expect it to move much higher unless we get a big surprise. On balance, given the risks on the macro side are probably to the downside, and we still need to see these happening, my reading is that on the 10-year US Treasury, we'll see lower yields as we move ahead in the next 6 months.
When you look at the 6 months balance sheet, what was the most interesting and surprising event for you?
I'm not surprised by anything anymore, quite honestly. I don't think we should be surprised by anything, whether it's geopolitics, whether it's macroeconomics, whether it's financial markets. Anything could happen. And I think that is the approach that markets are taking, that they're not surprised by anything. So we have to take it in our stride, if you like. And let's face it, look, I'm an optimist, and we've seen so many things happen over the last several decades. It's not worse than it used to be. There is just noise, and we have to deal with noise and some surprises. And I think, honestly, the US leadership has shaken Europe woken Europe up, basically. We need more defense spending, we need to defend ourselves against outside risks, and we need to deal with these issues of trade deficits globally. And this is something that I think Europe has to tackle.
Some say that the dollar issue is the most surprising thing. For example, everybody was talking about the parity, but now we are talking about 120, 125. In terms of euro-dollar parity, what do you expect for year-end?
Given the moves that we've had already, I think there could be some calming over the next 1 month or 2 months. The biggest challenge, I think, is obviously once the Fed starts to cut rates, which is probably not going to be right now, but the pressure could rise over the next 3 months. And then we see a surprise, maybe 2 rate cuts, 2 times 25 basis points rate cut at some stage. And that would be a challenge for the US dollar, of course, obviously on the weakening side.
Mm-hmm. So for year end, for example, what do you expect in terms of parity? And when do you expect the cut from Fed? And do you think Powell can keep his chair as well? This is an important question.
Well, I would hope that Mr. Powell could keep his chair, and I think markets in general do. As far as rate cuts are concerned, we're probably going to see about 3 rate cuts this year.
From Fed?
From the Fed, yes. Mm-hmm. By the mid of next year, it could be up to 4, maybe even 5 rate cuts. But it's all dependent on what happens on the macro front and what happens indeed on the tariffs front. How many tariffs, what kind of tariffs happen, and what effect this has also on the inflation in the United States.
Okay. We'll come back to parity and euro-dollar parity, but do you see a risk in terms of tariffs in the 1st of August?
I don't think we should be surprised by anything. The 9th of July was already delayed to the 1st of August. This could be delayed until the 1st of September, October. And quite frankly, I mean, let's face it, trade negotiations take a long time. They can take months, they can take years. So to expect the European Union to come up with anything concrete by the 1st of August is probably a little bit on the difficult side. So we may see some upside surprises, we may see some downside surprises. And Mr. Trump has said this very clearly. In his executive orders, there is upside and there's downside surprise on tariffs. So everything's open.
I think the markets are believing in this taco issue, Trump always chickens out issue. Do you think the markets will be right in this?
I don't think that there's chickening out is the right word, perhaps. I mean, I think the US administration is quite adamant about its position. And I think that we shouldn't get too complacent on that front. So there is possibility for an increase in tariffs. And let's face it, the United States is a relatively closed economy. It has an export to GDP ratio of about 7%, whereas Turkey is about 23%. Countries like Czech Republic or Hungary are about 75%. And the European Union is a much more open economy. So I think reading into this affecting the US economy too much over the long term is probably not the right approach. Immediate term one-off effects, yes, we'll see higher inflation due to the tariffs, but these are going to be one-off effects, and that's something the Fed's going to take into account.
Oh, that's an interesting point, actually. In terms of Europe, in terms of euro-dollar parity, and in terms of the pressure on the EM currencies, what do you expect, especially in terms of Turkish lira?
So the Turkish lira is a very idiosyncratic story, and it really is dependent on what the central bank does and the economic policy, the monetary policy, all these things. And we've known this for many years, a couple of decades now. So I think Turkey is very, very separate from everything else. And we need to see what the central bank decides to do over the next 6 months. As long as it's allowed to be independent, I think that's the most important thing for the Turkish lira. But in general, continued likely depreciation, which is also to be expected and I think wanted. And I think that the Turkish economy and population can deal with that.
Okay. Zooming in on Turkey, especially we're just days away from this 24th of July CBT decision. What do you expect, a rate cut?
Yes. I
How
mean,
many points?
A market, I think, expecting 250 basis points. It seems to make sense. And I think it will make sense also for the central bank to move in line with market expectations. You have to massage those expectations as the central bank. And given that we're talking about a lot of interest rate moves ahead, it makes probably sense that the market and the central bank are moving in unison.
Simon, for how many years have you been following Turkey?
Not enough, but around 25 years now.
Yes. It's a long time, actually. So as far as I know, you have even written a book on Turkey.
Yes, back in 2007 in English and in German. So,
really?
Yes,
in German as well?
Yes, so we did it in English and German. Co-authored, co-edited with a couple of people in Turkey as well, about doing business in Turkey, about the crisis since 2000.
What's the name of the book?
It's called Turkey, Profile of a Converging Economy.
Is it translated into Turkey?
It's not. No,
okay.
It's not. Yes.
It's for European markets.
It was for European markets, but Turkish people speak very good English and also very good German, so plenty of opportunities. No, but look, I mean, on a serious note, I think, Turkey to me is one of my favorite countries and to analyze, and I learned a lot by analyzing Turkey and using those analytic skills and that I developed over the years to analyze other countries as well. And I think Turkey has so much potential. It's just a question of getting the policy right. And let's face it, Turkey stands in the between so many different regions and countries, and it has to deal with it. It's incredible.
Yeah. So for these 25, 30 years, what is the biggest takeaway that you get from Turkish markets and Turkish economy? What did you learn?
Turkish markets are the most resilient in the world. You have plenty of volatility to deal with. I think Turkish people, the population themselves, can deal with these situations like no other country in the world. The interesting thing is that you never really had hyperinflation in Turkey, and there's a lot of discussions about this as to why that is the case. You know, unlike many South American countries, there was always sort of a limit, a cap on the inflation in Turkey, but it's been pretty high for some time now. So I think the inflation is the biggest puzzle in Turkey.
So when you compare this period with a period in the past, how do you compare?
It's a difficult one to answer, I think. Turkey has been through a lot of volatility, both domestic volatility and external volatility. And I think that taking all of those things into account, the central bank needs to deal with these issues the best way it can. And I think that the central bank in Turkey has always been very professional trying to deal with these issues. And I think it is one of the most important institutions in Turkey to deal with these issues as we move ahead.
So when you talk with the foreign investors and the investors for Turkey, what are the questions generally you get, and what are they wondering most? And do you think there's a great interest in investing money for Turkey?
There is always interest in investing into Turkey. No question about it. I think foreign investors have often been people in Turkey have often said that foreign investors are only interested in, messing up the currency, etc. It's not the case. Actually, foreign investors love Turkey. It's, again, one of their favorite countries. And I think everybody would like to be invested in Turkey. The only thing is to be able to deal with this volatility, especially the currency volatility, interest rate volatility. So once you feel relatively comfortable to be able to deal with that, and also to deal with politics as it appears and it comes, and all the surprises that may come, then people feel relatively comfortable to invest into Turkey. And I'm not talking about only market investors, but also foreign direct investors. Again, so much potential.
So as an economist, what do you expect in terms of inflation, in terms of interest rate cuts, and in terms of Turkish lira growth till year end?
I think we should expect inflation to fall further. It's below 25% maybe by mid of next year. We could see interest rates fall maybe about 1,000 basis points by the end of this year. And still, if you have those 1,000 basis points cuts, you would still have forward-looking real interest rates above 10%, which is quite strong. And this comes accompanied by a slowdown in domestic demand. So the central bank can deal with these sort of issues. And I think the most important thing for any Turkish consumer, person in Turkey, is to see a calming down in the whole macro backdrop, inflation, interest rates, and the Turkish lira.
Last question. What is the biggest risk and opportunity both for Turkey and for global markets in the second half of the year?
I think the biggest risk for global markets is that markets become too complacent and everybody is investing into this whole AI backdrop and expecting things on the AI front to cover up for all the other issues and volatility issues that we have. So if that suddenly falls apart and you have still high tariffs and new tariffs coming in, then we could have a big problem on international markets. Equities, bond markets, as you were alluding to before, and then also on the currency side. As for Turkey, I personally see that Turkey is moving really in the right direction now. And I think that we could see Turkey and the European Union maybe get even closer together in the future, also based on the pickup in tariffs that we're seeing out of the United States and all the risks that we are seeing. And I think European Union needs to wake up to this fact as well. Turkey is at its doorstep, and Turkey's largest trading partner is the European Union. So I think there's plenty of potential for the future.
So Trump will make European Union and Turkey get closer?
Could very well be, yes.
Okay. Simon, Quijano Evans, thanks for joining our program.
Thank you very much.